Morning, all. Sunny morning. Well, it is here, North Buckinghamshire. Right. What a fascinating week that was last week. Look at that. I mean, unfortunately, I wasn't around to do the workshop last Monday. I should have been, but I wasn't. I was crawling back from Paris after the Rugby World Cup final. Not a brilliant game. Not a brilliant game. Not for rugby purists, as it were. The atmosphere a bit not as you'd expect with no Northern Hemisphere sides in it. But yeah, great moves in the markets though. Gosh, I did watch it on Monday morning as I was waiting at Charles de Gaulle for my delayed EasyJet flight home. But what a fascinating week. Really, really, really strong gains in US equities. Yeah, well, yeah, sort of, Owen. Yeah, it's such a shame that Kane got sent off. Anyway, I won't witter on about rugby because it's probably not that relevant to any of you. Yeah, best weekly gains in a year, would you believe? So if you look at quick flip open onto the weekly, have a look at the weekly chart, blow that one up. You have to go all the way back to November last year. Yeah, look at that. Just extraordinary. Extraordinary because you just think in a week when interest rates were being deliberated and there's conflicts raging in the Middle East now as well as Ukraine, it's not the likely backdrop, is it, for an extraordinary move like that? Anyway, it happened. Main reason is that investors I think cheered the likelihood that interest rates are not going to go up again this year, certainly not in the US and probably not in the UK or the European, in the Eurozone from the ECB. Is this the start of the Santa rally? Owen, I need to be very clear about this because often we all, including me, get confused or sometimes misquote what a Santa rally is. A Santa rally actually is when the markets are really thin in the 2 days before Christmas and the 1 or 2 days after Christmas and before the new year. So unless you're having Christmas at the end of the week, it's a great rally, but it's not a Santa rally. No, the Santa rally by definition is just literally 1 or 2 days before Christmas. But typically, there aren't many natural sellers around running up to Christmas and the new year because that's when a lot of fund managers sharpen their pencils and are all ready to buy in the new year. So, yeah, statistically, you'd be advised not to go too short of the markets, but that's statistics. What did Churchill say? Statistics, damned lies and statistics. So, yeah, they don't always hold, do they? Anyway, but investors, traders, I suppose we probably do, believe that the Federal Reserve has concluded the current tightening cycle? What I mean by tightening cycle is increase in interest rates, and that whilst interest rates are clearly going to remain elevated for longer, according to Jay Powell from the Federal Reserve, Andrew Bailey from the Bank of England, Christine Lagarde from the European Central Bank, elevated longer, certainly more longer than we all expected a few months ago. And that the next move in rates in the US is likely to be a cut sometime next year. And it's interesting. Here we go. We're looking at the Fed Watch tool. A 90% chance of no change. Do you remember it was, gosh, well, look, you can have a look here. So if you look at the 550 to 575, a week ago there was a 24% chance, 25% chance of a hike of 0.25%, but that's all evaporated, well and truly evaporated. And if you want to look next year as to when there may be a cut, you can go to March. Okay, no chance of a cut in March, but then when you get to May, wow, look at that. 45%, 55, 56% chance of at least a 0.25 point cut, and by June next year. So these are the dates of the Federal Open Market Committee meetings next year. So 31st of Jan, 20th of March, 1st of May, 12th of June. So the 12th of June meeting, yeah, there's a very strong possibility that rates will have been cut by then. So that's what we're all cheering we're cheering it because of what's been said. Anyway, so this is what was last week is what's called a very, very strong risk on move, a risk on move. This is where investors, traders buy equities. Yes, equities are riskier than bonds, riskier than cash. So it's referred to as a risk on move. Let's get back to the daily, shall we? It's a little more. Yeah, that's it. So this massive move, I mean, it's just extraordinary. Um, it's yeah, uh, part of that risk on move, as I said, where bonds rally sharply, and whilst the US dollar falls. And I think the US dollar actually had its worst week since early July. So that's all part of the makeup. Commodities, yeah, oil was weaker, which is a little bit not quite in line with what you'd expect, but that's oil's move is largely driven by what was happening or what is happening in the Middle East and the threat of a spread in this conflict between Hamas and Israel. And I think the oil falling last week is likely down to the fact that there's a feeling that the conflict is contained for now, and that's the reason why oil is where it's at. Anyway, US equity markets were the most notable beneficiaries, as you can see looking at this chart of the S&P here. The S&P 500, which is what we're looking at here, the NASDAQ, NAS 100, and the Dow Jones, or US 30, all posted their best weekly gains since November last year. And that's really on the back of the announcement of the unchanged rate call by the Federal Reserve last Wednesday, and then the really extraordinary release of the non-farm, I say not extraordinary release, but the release of the extraordinary non-farm employment data, which really then underpinned the view that interest rates had likely peaked and that rates would start to come down in, well, what were you looking at just then, May or June next year. So if we have a look at that data from last week, scroll down to Friday. So it just everything was better than, well, okay, it's red, but it's better for the markets is what I'm saying. So the number of jobs was 150,000. That's less than 178,000 was expected. The previous month's data was revised down from, I think 336 to 297. So that's another 40,000 jobs on top of that. Sorry, a reduction, I should say, on top of that. The employment rate 3.9 instead of 3.8, and the average hourly earnings plus 0.2% instead of plus 0.3%. I hear you say, Jerry, what are you telling me, that the data's worse than expected? Is that why the market's rallied? Yes. The reason why the market has rallied is because interest rate expectations have taken a shift down. So now, yeah, it implies, with this weak data, implies that the employment picture is starting to loosen up a little bit. There aren't so many vacancies. There are more people looking for work, and that's really what the central bank is looking to achieve. There was always a big concern that if the Fed was forced to keep raising rates into the new year, that they would create what's called a hard landing, where the US economy went into a mild recession. Anyway, that doesn't look like it's going to happen. And I think most analysts believe that the US economy has achieved something called the Goldilocks scenario, so not too hot, not too cold, where rate rises have cooled the economy sufficiently to allow price pressures to abate, but without pushing the economy into a recession, which is, the ideal scenario. That's the way it is for now. But as you know, I only report what's happening in the markets, but it does ebb and flow from one week, 1 month to the next. So yeah, we keep watching it very, very closely and reading all the tea leaves. But of course, the Federal Reserve, they decided last week to keep rates unchanged, but comments from Jay Powell. Let's just go back to last week. Yeah, so comments from Jay Powell last week. He basically said that interest rates would not be going up, but actually he reserved the right to put them up. And of course, that's what all central bankers say. In fact, what he said last week was that the central bank was proceeding carefully with future rate rises, which implied to analysts, and I don't quite understand, there must have been further discussions about this, because apparently analysts decided that that particular comment basically said that the task of raising rates was at an end. I'm not sure how they did that anyway. Oil needs to pull back somewhat, said Owen. Oil does, Owen. And I think the risk for central bankers is that what's happening in the Middle East makes the outlook really, really uncertain. What probability is that we get another energy price shock? And you see oil, I mean, was it the IMF or the World Bank said that oil could get back up to $150 a barrel? Yeah, that's something we need to avoid, or the world economy needs to avoid. OPEC would probably love it. Yeah, it's we do need oil to come back further. That would really help the outlook for inflation. Other caution, yeah, there was this chap, Thomas Barkin, who's the chair of the Federal Reserve in Richmond, was reported as saying that it's not clear if rates had peaked yet, and that any potential cut in rates was still a ways off in my mind, he said. I wonder whether he talks like that, probably not. And Jay Powell, as I said, also reiterated what almost all central bankers are saying, that rates may still need to go higher if there was another energy price shock that we've just been discussing, Owen. So yeah, I agree with you. I think the oil does need to come down. A notable caution by Fed members and other central banks is really not surprising, because market reaction can result in stimulus to the economy. What do I mean by that? When you look at what happened in the bond markets, the US sovereign bonds, these are called treasuries, rallied really hard last week, with the 10-year yield touching 4.5%, which is the lowest yield in a month. And he's saying, well, so the bonds rallied and the yield fell. Yeah, because the yield is inversely proportional to the price. So as bonds rally, the yield comes off. That means interest rates are lowering in the sovereign bond market, and that's where a lot of loans are based on: corporate loans, retail loans, mortgages, etc. The interest rate sensitive 2-year note in the States, that fell to 4.8%, the lowest level in 2 months. I think the 10-year last week fell by 19 basis points in a day, which is one of the biggest moves, gosh, since the great financial crisis. Just absolutely whopping move. And this effective cut in borrowing costs will mean lower costs for businesses, lower costs for retail loans, for mortgages, which could further bolster the economy. This sort of action is referred to as like a soft loosening of monetary conditions, and it's something that the Fed don't actually have any direct control over. It's what the markets are doing. Anyway, for now, it appears that the Federal Reserve has achieved a balance in price pressures and economic activity that I think we'll all continue to watch really closely, especially, Owen, if price pressures start to build because of oil spiking, if that does happen. And I think, as I was saying, I think the likelihood of such a scenario, it is very uncertain, especially with these two conflicts raging in regions that could really still, as I said, cause energy costs to rise again. Right. UK, yes. Question about UK. UK equities actually posted pretty strong gains. Nothing like what happened in the US. And actually, I don't have the chart up here, but the FTSE 250 was the real beneficiary last week. Obviously, with the Bank of England keeping interest rates on hold for the second month in a row. Is that positive? It sort of is. But Andrew Bailey, oh my God, I don't know. He must have got out the wrong side of bed last Wednesday, but it was Thursday, I should say. It was so depressing listening to what he had to say. Not sure whether I believe much of what he said. And again, this goes down to central bankers needing to control the elements that they don't have direct control over, where bond yields go, which can create, looser or tighter monetary conditions. Yeah, I think the FTSE 250, from just what I was looking at before I came on, 950 points in a week. That's huge, isn't it? I think 5.5%, 5.6% on the week. That's a great move, absolutely great. And I think the best performance again since November last year, when we had that big massive risk-on rally last year. Anyway, Andrew Bailey, he warned that rates would stay elevated for longer than some expected. This was his gloomy take on it last week, and that growth would remain below historical averages in the medium term, which I sort of agree with. UK rates are not so clear cut in the US. 3 of our members, have a quick look at the calendar. 3 of our members last Thursday. Has it gone? Am I in the wrong week or month? Where's our Bank of England? Oh, is it the following week? I'm going mad. Yeah, it is. Apologies. Yeah, it was 306. So 3 dissenters as expected, but that's why it's not so clear cut. It was unanimous in the States to keep rates unchanged. Anyway, I think there remains a possibility that rates will have to rise again, certainly if price pressures fail to fall near the bank's target of 2%. So again, Owen, a lot of it does hinge on oil, which hinges on the outcome of the Middle East conflict and whatever. But that looks like a very long, drawn-out conflict with Hamas living in tunnels below Gaza City and wherever. But I think we might be reading that in the news in our media for months and months to come, I'm afraid. Anyway, going back to the UK, we talked about, is a reason for further rate rises here in the UK. Yes, there are. But actually, if anything, the argument for the European Central Bank and the Bank of England not to raise rates further is stronger than in the US, which we know where economic activity is far stronger. Anyway, the Bank of England's assessment, very bearish, a lot more bearish than analysts expected, although I think market expectations need to be influenced to ensure that conditions don't ease too soon, as I was saying about what was happening in the US. Gilt yields, gosh, look at that. I think you're going to see more competitive mortgage offers. So any of you in this workshop who are having to redo their mortgage because your fixed deal is coming to an end in the next few months, the good news is that the 5-year yield fell to 4.26%, which is really good news. And this is, there you go, is this the turning point for interest rates? It was all about that last week. Quick look at bond yields, because it's worth having a look. Although something happened with the FT's charts. They've lost one of their graphs, which is a bit weird. Anyway, if you look at the 5-year, 4.27%. A week ago, 4.6%. Yeah. So quite a shift down. Good news. Yes, it is good news. The dollar last week, well, we all know what happened to the dollar. I can actually got the dollar index here. The dollar fell quite sharply in this risk-on move, which is what you'd expect, expectations about interest rates, etc. But the biggest fall in the dollar since early July, and it's the interest rate outlook that had a direct impact on the US dollar, which fell quite sharply on Friday, didn't it? That was that big move following the non-farm employment data, which, as I said, clearly implies a cooling in the employment market. To what extent central banks are close to concluding their interest rate tightening will influence the US dollar trajectory over the medium term. And I think this initial fall in the US dollar is as much about a risk-on move rather than about interest rate differentials between the US and its trading partners in the Eurozone and the UK and in the Far East. Let's face it, if they're not going to raise rates in the US, well, they definitely shouldn't be raising them in the Eurozone or the UK. Well, gold, we had looked at that, or Stuart was looking at that. That didn't really benefit from the notable fall in the US dollar, which is what would normally help a US dollar-based commodity such as gold. But I think it was that global macro picture had been more of a driver over the past month, and I think the hostilities between Israel and Hamas continue to rage, although it looks like the conflict's being contained. Hence the reason why gold is struggling to punch through that $2,000 an ounce level. But this is all down to some massive Chinese People's Bank of China buying of gold over the last 4 or 5 weeks. They bought a huge amount of gold. Anyway, let's go on to the calendar this week. Well, you probably wonder why I've been wittering on and haven't got to the crux of it this week, i.e. what's coming out, because there's not a lot. As you know, we are back to our 5-hour differential between us and the US markets. So normal service resumed, just a difference of 1 hour for just 1 week. Now that the US have concluded their daylight savings shift, we are back to those to that 5-hour differential. This week, well, 2 weeks of busy 2 weeks of data releases. This week is notable for how few releases there are. I think the highlight of the week is probably the consumer sentiment data out at the end of the week. We've got Chinese inflation data and also the Reserve Bank of Australia's rate decision, which is a bit of a, not sure whether they will or they won't. So a bit of interest there. So just quickly, lots of central bankers talking this week. Why do we want to listen to central bankers? It's not because they're great at speaking. It's because they sometimes drop clues as to what their interest rate policy guidance view might be, and that has a significant influence on us traders and investors. We love to know what the central banks are thinking, especially in these times where interest rates have been shoved up to 40-year highs over the last year and a half, year and 3/4. Anyway, first one, Mr. Ueda, Governor Ueda, the new, relatively new governor of the Bank of Japan, in a press conference in Nagoya, apparently, wherever that is, comments about yield curve control measures, possibly. So the Japanese yen will be sensitive to that, which has already happened. Construction PMI data out in the UK. Construction sector activity fell alarmingly last month. In fact, yeah, because it fell to 845. I don't know what on earth was going on there. Yeah, that was, yeah, there may be some adjustment to that data, but anyway, sterling will be particularly sensitive to that release in 10 minutes. Tuesday, we have the Reserve Bank of Australia's rate decision, so the cash rate. It says a 1/4 point hike in rates here, but it's a close call. But the bank may well raise rates to 4.75%, sorry, to 4.35%. But they've had 4 successive unchanged decisions so far, so the Aussie dollar will be particularly sensitive to that announcement. You will wake up tomorrow morning, if you haven't been awake at 3:30 in the morning, to the news already. It will have passed you, but you will see the reaction in the foreign exchange markets with regards to the Aussie dollar pairs. Wednesday, it's all about central bankers talking. Mr. Andrew Bailey, he of our own central bank here in the UK, speaking at the Central Bank of Ireland's Financial System Conference in Dublin. Why is that interesting? Well, it's not actually to us, but the sterling will be sensitive again to any remarks regarding the part of UK interest rates. Jay Powell as well, speaking at an event in Washington, clues on interest rates, etc. all welcome. The dollar will be sensitive to Jay Powell's comments. And then we get on to Thursday for the Chinese inflation releases. China's actually wrestling with a period of what's called deflation. What I mean by deflation, negative inflation. And it's something that it looks like a brief period, apparently. But deflation does need to be avoided because it gives no pricing power to any manufacturing businesses. It's impossible to raise prices. If it's impossible to raise prices, is it difficult to then commit to spending money on investment in your own business? The CPI data is expected at minus 0.2%. PPI, Producer Price Index, that's this one, is the cost of goods and services going into production. But I think this lack of inflation may be short-lived because the PPI is recovering. If you look at this graph here, you can see quite a recovery in the Producer Price Index. But it still means that there's a little more deflation down the tracks as PPI starts to build up again. Anyway, that could affect global markets depending on how horrific that data is, but as long as it improves or is close to consensus, then there won't be too much of a bump. Christine Lagarde, she's chair of the European Central Bank. This is weird. So she's speaking at the inauguration of the House of the Euro. What on earth is the House of the Euro? Have they built a house out of Euro banknotes? Maybe. Anyway, it's in Brussels, whatever it is. Rate clues, as always, the focus for traders. So the euro will be sensitive to what Christine Lagarde says. 5:30 in the evening. You might have shut up shop if you're day trading, but if you're swing trading on your on D1, you'll be waiting until the end of the day, by which time whatever she said will have impacted the markets. Jay Powell, he's talking again, this time at a panel discussion entitled Monetary Challenges in the Global Economy. Well, I think that's a little more relevant to what we do, certainly more relevant than the House of Euro that Christine Lagarde is speaking at. And then we jump to Friday, probably the most important data out in UK this week. This is the release of the quarterly and monthly gross domestic product numbers. This tells us the value of all goods, all services produced in the whole of the economy. Well, when they release the prelim number, they've only got 40% of it. And Aussie rates are tipped to go up. They are, absolutely they are, but it's a close call, Owen. So when it says 4.35%, that is a quarter point hike from the previous rate, but they've had a close call for a couple of months now. So are they going to decide to move this time round? So there will be some reaction because it's quite a close call, as I said. So the GDP data out in the UK, GDP data, it's backward looking because it tells us what has happened in an economy, in this case, in the UK economy, and it won't make great reading for the Bank of England. The quarter-on-quarter reading is a minus number, minus 0.1%. 2 quarters of negative growth is the definition of a recession. So we'll have to see how that turns out. But the monthly data makes up part of the quarterly data. They never used to release monthly data, but anyway, the reason why the quarterly data is coming in minus 0.1 is because the monthly data is coming in at flat rather than an increase of plus 0.2%. We'll wait and see how that turns out on Friday. Sterling is a bit sensitive to that, but as I said, it's a little bit backward looking. And then finally, a number that is forward looking, which is what we're more interested in, is the prelim University of Michigan consumer sentiment and also inflation expectations. It gives us a clue about future economic activity in the US, and that's what we need. We don't need to tell us what has happened in the past because we can see what's happened in the past in terms of market activity. So the consumer sentiment and inflation expectations, quite interesting. So 3 o'clock on Friday, and the dollar will be sensitive to that particular reason. That's it. No blockbuster releases this week, but wow, what a week last week. What a week for US equities. I mean, the Nasdaq, was the Nasdaq up? Remember, look at my quick notes. The Nasdaq was up. Yeah, 920 points, 6.5%. Well, anyone looking at their 401ks in the US, or dare I say, if you're looking at your own SIP over here, you'll have some, hopefully I'll have quite a lot of an exposure to the US markets. It'll be looking a little bit better now. Anyway, that's it. Listen, have a great week, rest of the week. And we will redo this time next week. Well, 8 o'clock next week, that is. Catch you next Monday. All the best, and yeah, bye for now.